There's a perfect storm coming later this year, and so I wanted to jump on real quick and just give you my thoughts. In this video, I'm gonna go over when I think that this perfect storm is gonna hit, what this means for investors, then how I'm going to be investing leading up to it and during it, but then also how I think some of you might invest, especially if you're closer to retirement age or at retirement age. That will likely provide a little bit more safety and possibly more upside if you do what I say. And if you're new to my channel, my name's Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. So it feels like we're in the middle of a storm right now, and actually we kind of are, but a worse one is coming. Right now, we've been in a down market for a little over a year now, with the total US stock market down over 12% for the last year. Inflation has been sky high for a while now, topping out over 9% last June, and now closer to about 6%, which is about 3 times higher than we're used to, or the normal yearly average. Because the Fed keeps raising interest rates, people are starting to feel the burn in many places, causing home loans and credit card debt to soar, so people can't afford as much as they used to. Credit card debt has hit an all-time high as people are barely being able to afford basic necessities, so they surely can't pay their debt down. And then to add to the mix, banks are collapsing left and right, so people are losing trust in the financial system overall, which could cause a domino effect that really messes things up. On top of that, many are starting to really feel the market slowdown by being let go from jobs as layoffs are increasing, and not just in tech. Forbes literally has a layoff tracker showing each company that's been making massive layoffs. Among them lately are Walmart, Indeed, Tyson Foods, General Motors, and Disney. So first of all, make no mistake about it, we are in a down market. I know there's a lot of people just sitting around saying, I'll buy the dip once that dip happens, and once we start to get into a down market. We're in it, folks. But I do believe we're gonna drop a good amount further for one big reason, and that's gonna happen around June of 2023. So a couple weeks ago in February, the Supreme Court met to discuss a very big issue. And that issue was all about student loan forgiveness. And what came from that meeting is gonna be huge, but either way, once people have to start paying back their student loans, even if it's less amount because they get some forgiven, it's gonna be detrimental to the stock market. So as far as when the repayment might happen, if the court issues a ruling a few weeks after the February 28th hearing, repayment could restart in May or June. But if they wait until the end of the term, in June or July, then there'd be an August or September restart. And this is a much bigger deal than people are realizing. Because even if people do get student loans forgiven up to the $10,000 mark, most people have student debt of over $37,000. This means that most people will still have those student debt payments, and those payments are anywhere from $200 to $1,000 per month. And now our financial system has kind of given people a break, and what that's done is it's taught people very bad habits. Because do you think that people are taking that little amount that they were supposed to be using for student loans and just putting it off to the side? Or do you think maybe they're using that money and either buying things that are fun or going out to eat or things like that, or possibly even just putting that money into the stock market to try to beat the system? Now, the way to make a stock market crash is for a bunch of people to take a bunch of money out of the market, because at the end of the day, it's all about supply and demand. So as soon as a bunch of people sell their stocks, now there's more stocks there, which means higher supply, lower demand. That's going to cause a market crash. So as soon as these people actually have to start paying back these student loans, and it's a monthly payment every month, they're not just going to find that money magically somewhere. The only logical place for them to be able to find that money will be to take it out of their investments. And so my prediction is 2 or 3 months after people have to start repaying their loans, that's when we're really going to start to see a big dip in the market, and that's when we should be ready to load up. So now, how am I investing knowing this knowledge? And then remember, after that, I'm going to go ahead and explain how I think that some of you that are closer to retirement age, or those of you that just want to be a little bit safer maybe in your investing, I'll tell you how I think you should invest as well. And for those of you that haven't already, you should really check out our Patreon group, because we talk about these types of things weekly and have live Zooms where we can keep each other accountable. It's a really solid group of like-minded investors, so if that is of interest, it only costs $20 and you'll be able to have direct access to me for any questions as well. So as far as my investing right now, I'm going to be investing with the mindset that I've always had, which is that I'm not investing to pull this money out next month or next year or even next 5 years. I'm investing for this money to stay in there for at least 10 years, very long-term thinking. And so what's going on today likely doesn't really matter compared to what it's going to look like 10 years from now. Based on just inflation alone, I know that prices are going to be much higher, assets are going to be worth much more, and since I'm buying assets in the form of stocks, I know for a fact that all of these solid ETFs and also solid blue chip stock are going to be worth more in 10 years than they are today. So I'm happy buying right now, even if I know that the market's going to dip a little bit further, because if we're talking about the difference between buying something at $70 versus $75 versus $65, that's not going to be a huge difference when later on the price is $150, $200. It really didn't matter back in this time, but it's hard to see that when you're in it. But since I do definitely believe that we will drop a bit, especially when student loans have to start being paid, the way that I'm investing is for my investment money, right? Like I hope that you're budgeting and you have certain money in certain places, but for the money that I'm allocating towards investing in stocks, I'm putting 90% of that into the market. And with that, everything that goes into the market for right now, I'm really just sticking with my 3 ETFs that I like. And I'll go over those a little bit more later, but it's a foundational ETF like the S&P 500 or VU. It's a dividend ETF like SCHD or VYM, and it's a growth ETF like SCHG or VUG or QQQM. I'm basically just splitting 1/3 of my money into each one of those 3, not doing anything cute or fancy, and just sticking with that right now during this volatile market. Now with that other 10% of the money, I'm just putting that into a high yield savings account, and specifically I like Capital One. It's very easy, they have good customer service. It's been really, really good for me. And with that, I get about 3.5% on my money, and so I'm just putting money there and I'm waiting until that big drop happens. Then when that big drop happens, I'm going to take all of that money out of there and I'm going to throw it all in, and that's my personal plan. I do think this big drop is going to happen right around Q4 of 2023, which is those last 3 months in 2023. If though we don't see a huge dip and maybe they do something like push back the student loans even further, or they just forgive everything, or something crazy happens, then cool. I'll just take all of that money out of the high yield savings account and I'll throw that into those ETFs at that time, and I'll be totally fine with doing that because again, I'm not investing for next year or the year after. I'm investing for way down the road. Now, if you're closer to retirement age or in retirement age, I definitely recommend that you're still in the market. There's a lot of fear and a lot of people are scared for their safety, which you should be. And obviously, I'm not talking to all of you. If you don't have a safe emergency fund where you have at least a year's worth of money sitting to the side, then maybe it's a good idea for you to really pad that up, especially during this crazy time. But for those of you that are ready and want to take a little bit more advantage right now, a good way for you to invest, in my opinion, would be for you to take all of that money that you're planning on using for investment each month, and I would take 50% of it and I would put 50% into the market, into great ETFs, and maybe since you're closer to retirement age, there shouldn't be much of that growth ETF. It should be a little bit more in the foundational ETFs, or even a value ETF, more like the dividend one, SCHD. But again, do your research and figure out the best one for you at this time. And then with the other 50%, you're putting all of that into a high yield savings account. Now, yes, you can get much more interest on something like a CD, or even certain bonds, or T-bills, or different things like that, but the problem with a lot of these is that it locks up your money. So the reason why I really like the high yield savings account for this strategy specifically is because you can take money out of that high yield savings account at any time. For most CDs, it's at least a year that it's locked up. And in my opinion, we have less than a year for when that drop is gonna happen. And so you're gonna wanna be able to pull that money out to be able to really make a bunch of money on this big dip. The reason why I like this strategy so much is because if you're putting some money into these ETFs and putting some money into a high yield savings account, at least you're making that 3.54% on the high yield savings account money. And so even if we drop a little bit on some of that other money, it's probably going to even out. And then if we do hit that big dip and you throw that money in, as soon as we make that recovery, you're just going to look like a genius and you're going to be laughing all the way to the bank. To learn more about the 3 funds that I was talking about before and to figure out exactly how much of each you should put in your portfolio based on your age, watch this video here. And if you've already watched this video, then I recommend watching this video, which is going to talk about 3 solid but risky investments I really like to add to my safe stuff in order to get very rich very fast.